In self-storage, you could be the smartest operator in the world, but if you're in an oversupplied market, you'll get killed. You can be an idiot in an undersupplied high-demand market, and you will be wildly successful.
You'll look like a genius.
Genius. The migration patterns have really, really driven real estate, and it's been wildly uneven. Some places are net shrinking, and other ones are net exploding. Rates have to be above a certain level, and that's especially true with how much building costs themselves have been driven up over the last 4 years. Like, you have whole sets of markets that do not make sense anymore. Welcome everybody to Self-Storage Income. And today I have a guest with us, and Brady is, well, I guess technically, are you still a Canadian, Brady?
I'm working on exiting as we speak. We got about 17 more residential properties and I'm out of there.
Right on, man. So you transferred over to the storage game, and you specifically focus on land and development, correct?
That's correct. Yep.
Okay. Well, why don't we hit on first real quick? When did you come down? When did you make the move?
So we came down in December of 2021, basically January 2022.
Okay.
And we didn't really know anybody. Well, we didn't know a soul down here. But we did know we were kind of done with tenants and toilets. We'd done a few hundred properties up there in Canada, multifamily, smaller multifamily, and had a construction company, property management company, did a lot of land entitlement and ground up development there. And when we came to the US, we just decided we were done with that. We're going to find some people that knew how to do storage. So we came down and bought a bunch of residential stuff just to kind of make some US dollars. And then we kind of jumped into storage with 2 feet right in the deep end with the weighted vest.
There you go. That's the best way to do it, man. So a lot of people will go acquisition based, but you went at storage going the land. Like, did you go full on bare land, permitting everything, or did you go look for good development sites and then try to find land that was already ready to go? How'd you go about that?
We just went right into the land development game, and we found a couple sites at different times, and then put together the team around us that have done storage and have done ground up development in storage, and an architect that specializes in storage, who really kind of quarterbacked those first couple deals. And went through the entitlement process, the design, permitting, etc. And we syndicated both of those deals. But that's where everything was going great until the debt got hard at the end of 2022. And that's kind of where we're like, whoa, let's put the brakes on. Just we'll focus on getting these two done. And then we ended up focusing more on sourcing land specifically for self-storage. And that's kind of what one of our companies does now, is just purely source land off market for self-storage development, really focusing on undersupplied markets, high rental rate markets. And then we'll do all the entitlements, get it through fully approved. And then we'll end up either developing it ourselves now, or we'll sell most of the sites to other developers.
Okay. And how many developments do you have currently going on?
So currently right now I'm actually flying right from here up to a public meeting in Atlanta, Georgia. There's a site there that's going through special use approval. There's 2 in Dallas. There's 6 or 7 right now that are moving through a variation of entitlement. Some of them are rezones. A lot of them are special use, conditional use.
And have you seen a big change in the last few years on where storage demand for development? Obviously, that's very different. How has that changed in the last 3 years?
Yeah, well, I think the biggest thing is that the syndicators are gone for the most part, right? So our client is, would have been a syndicator at one point prior to the debt getting really challenging to get. But now the buyer pool you look at the top 100 operators list. I mean, not all of those develop, but pretty much the ones that do are the buyer pool. So it's very small, right?
Yes.
And so with that, they have very tight rules as to when they can close, and obviously they have to be the best of the best in undersupplied markets. So it's challenging. I mean, it's a needle in a haystack. And it always has been, but it is even more so now. So we're looking everywhere, man. Like, I mean, what really drives us is strong rental rates. Like, we won't even look into a market unless it has those strong rates and a reasonable supply. And then you still have to find a story. Like, what is the growth? And obviously, lots of other components with regards to traffic and things. But yeah, it's hard.
And this is a really good point because there's different kind of line items of metrics that we look at that are in the approval process for land piece, which you're right. The first one would be rates, as in if rates are below a certain point, doesn't even matter.
Doesn't even matter.
Nothing else matters. That's an automatic. So rates have to be above certain level. And that's especially true with how much building costs themselves have been driven up over the last 4 years. Like you have whole sets of markets that do not make sense anymore. They just don't. And then from there, the next thing is competition. Like how much square feet per capita, how saturated it is. And then you're right. After that, then it becomes the story. So is this a viable thing? And now when you're looking at that property, we've talked about those two. What are some other things that you'd be like, these are just no-goes? Like we see this, we walk away.
Honestly, you might find a great site, and the political landscape has a huge impact too. And then also from our standpoint, there's certain states that are just much easier to sell parcel of land for development in, and there's some states that are just significantly harder.
Yep.
Right. And so flood and wetlands is another big thing. Topography is another huge thing. I mean, depending on where you are, if you're in Arizona, in different place, there's all kinds of archaeological issues that you can run into. But yeah, I mean, it's crazy because it's a mixed bag. I mean, every single site is its unique. There's not just a standard checklist that you can go through to get these things approved and entitled. But I mean, getting it approved and entitled is one thing, but then making sure that you can sell it and have a developer actually want that parcel is another complete thing.
Well, and to that, I pulled up this morning. So I looked at a few things, but we were like, okay, let's get 2024 last year. I wanted to really kind of analyze which states, net migrations, which states are growing. And you had, on the states overall, and that means just as total number of people moving there, South Carolina, Texas, North Carolina, Florida, and I'm going from number 1 down. Tennessee, Arizona, Georgia, Nevada, Idaho, and then Colorado at the bottom. Now, when we looked at that on like a per capita basis, the first one was, and that means how many relative people are moving there relative to it. I view that as more of an impact metric, right? We have first South Carolina, second Idaho, Tennessee, Nevada, Montana, North Carolina, Florida, Arizona, Utah, and Texas. So those are the top 10 that have the biggest impact. Like people are moving there and it's like driving a lot of stuff because it's relative to how many people are currently there. That's a big deal. The last 4 years, I mean, the migration patterns have really, really driven real estate, and it's been wildly uneven. Some places are net shrinking and other ones are net exploding. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. For us, it was like, oh, this will end after COVID. It hasn't. So the same states that were winning during COVID are still in 2024, they continue to win, and also in a big way, even though the feverish of it may have calmed down, but they're still by far winning, and the states that were losing are still losing. And do you see that when you're dealing with storage operators like us and other people? Is that something that they're looking at driving interest? I mean, what is the feel on the impact of that?
Yeah, I mean, from our perspective, we ask for a buy box. Obviously, it's like, AJ, tell me your top things. Most of them are the same, right? But the more check boxes, if you had 10 things, the more of these things that we can check off for you, the easier it's going to be to sell it to you, right? And part of the story market on, whether there's big Intel development going in, there's going to be bringing billions of dollars of development, check the box, right?
Yeah.
Population growth is a huge thing, especially in markets that are, maybe close to the state average or, maybe even slightly above or maybe have a little bit lower climate control and it's going to be a climate control play. Then give me some other reason. And they want it. I mean, they need to see growth in those types of situations. So yeah, it's definitely a thing. And then, from there, it's like, where do you get your data? How often do you update your data? And because all of these things are really moving the needle as to whether a good deal is a good deal and whether you can portray it and actually prove it's a good deal.
Yeah.
Because bad data or old data it can be the difference between making a deal or not too.
Absolutely. We just did a big conversion that opened up last fall. And it's in a market where a lot of the market is vastly overbuilt. I'm talking like 30 square feet per capita, right? Rates have been going down, everything else, but we found a sub market within it that kind of met a whole bunch of requirements. And in fact, kind of blew them away. But that deal, we've been filling up at it's over 2% a month in these slow seasons. We have not even had a busy season. And we're going into the busy season 6 months into it, 30% full, and we haven't even hit a busy season yet. Now, I know other sites that are 3 years old and they're not 60% full. In fact, we're buying one that was managed by a REIT that is 3 years old and they're 50% occupied.
Right.
So it used to be just everything filled up. Those days are gone.
Yeah.
Your personal ones, why did you choose them?
So they were, from a supply standpoint, it's very undersupplied. And that was the big thing. And the rates were okay based on the interest rates at the time. They're $18 on average annual. But undersupplied by like 600,000 square feet. And so those were the big factors that really drove us to those two markets. I mean, they are in Houston, so that is kind of a part of so depending on who you are, some people don't like Houston because of, you can kind of just, it's the Wild West. Would I have gone there knowing what I've known now? Based on seeing what the market's done in those two locations, because nobody else has come in since we've started, which is great. But, you learn as you go, right? And since we've definitely sharpened our pencil because you have to, I mean, to get debt and to get investors, like these things have to, and to mitigate your risk, I mean, you have to have, tens right now.
Yeah, you really do. The real and perceived risk is much higher, right? And that is driven with obviously uncertainty, particularly around interest rates, because it correlates so closely to housing, So for us, interest rates go down 300 basis points, that wildly affects our industry. That really, but too, if they go the opposite way, it does. And we've seen a lot of people and banks that have just been risk off. Have you seen any change in that in the last 2 years?
I've seen a little uptick in the last probably 6 months, just when we're shopping debt and having different conversations. One of our brokers is from Marcus Milchap. He's been seeing an uptick in opportunities, been able to get lending out. So that's good. But I mean, I think this still in large, it's still tight. I mean, it's not like you can just go. And I think one of the biggest challenges I think that we experience being Canadian is not being able to leverage previous relationships. Some of my friends and now business partners have those relationships, and that makes everything infinitely easier. And so that would be one of the pieces of advice that I'd give to anybody, is that if you're not quite there in whether it's development or acquiring, the relationships on the banking side are ultimately the thing that you're going to be able to lean on to get these deals done.
Yeah.
We've been fighting an uphill battle because of that, and being Canadian doesn't help.
Yeah. I can only imagine on that. So tell me about that, man. I want to take it back. Like, you were just a real estate investor and you're like, hey, we want to head over to the United States. Like, what really fueled that?
Yeah, well, so my wife and I started the company in 2015, and we had done at least 150 properties by the time COVID happened. And then when COVID happened, we were building our big dream house and we were living in one of our rentals. We had a baby, we were pregnant. We had a 5-year-old girl, and of course they locked down. And I did the 75-day hard.
Yeah.
So, which is like no alcohol, working out twice a day. It was the first time I stopped, wasn't drinking socially for, since I was like 14. And I just got the courage and clarity. And we ended up taking the family to Costa Rica for 4.5 months. And the deals got bigger. We did a whole bunch of ground up. We started a bunch of ground up multifamily developments. Life was great. And then when we came back to Canada in the spring, they locked us down again. And I said that next winter we're going to the US just for freedom and to scale business. It's just everything's harder there from a financing perspective and just even in the mentality of scarcity mindset versus just the abundance mindset.
Yeah.
And not everybody, but most. And so, yeah, that's why we came to the US. We said we were going to do it in December of 2021. We packed the kids stuff up in the car for the entire winter and had no plan and nowhere to go. I went to a mastermind and figured it out from there.
That's awesome, man. Like that's got to take a lot of courage. That's not a small thing, especially because you were obviously not, it's not like you had nothing to lose or anything. You built a business, you had assets, you had, you know what I mean? Like that's amazing. Good on you. How is the storage environment different here than there?
In the last few years, it's really picked up. I mean, once we got into development, I created a few relationships in Canada, and like in my hometown, probably a year after we left, so just 2 years ago, there's another 5 brand new facilities being built or in planning, and this is in a town of 180,000 people. Right. So it literally was like Apple storage, all these big, guys were just like, it just started blowing up. But the land costs are just so astronomical. Like what you can buy down here, even in say Florida, like we've got one that we're going to contract for 4 acres in a good market that has $24 drive up rental rates, 10 by 10 drive up rates for 1.2 million for 4 acres. It's 1.2 million an acre in this, little town north of Toronto. Right. So it's just like to make that work. From a ground up development standpoint, it's pretty tough. And then the building anything in Canada is a lot like building it in likely New York or California, probably closer to California.
Yeah.
It's painful.
The development process on that, like how is the approvals? I've wondered that. So like, going through approvals, obviously in the United States, each state is very different. Yeah. Obviously Texas to New York, California, wildly different. Is it the same in Canada or is it just kind of more uniform? And what does that process of permitting and developing look like there?
I guess it's similar in the fact that each municipality is different, like same as here. But it's just slower. I just find in general, it's slower. So especially when you go, and we have a lot of NIMSYs, we call them not in my backyard people, and they rant and rave, and these council people will just listen to them and defer and defer and defer. And so, and I'm talking little, when we were doing a lot of land entitlements, it was with regards to affordable housing and creating affordable housing units, which is, we're in a housing crisis, but like to get anything approved for a second suite or a detached accessory dwelling unit, it's so political. So yeah, things just took a long time, and it would take years, where in some places here that we've experienced, you can get some of these special use or rezones done in months.
Yeah,
it's painful and it's expensive and it's risky because you obviously you don't know whether you're going to get it approved or not.
Yeah, I mean that's a wild difference.
Big difference. Yeah.
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
You made this huge move. You've gone from one asset class to the other. You're specializing in, which I love how you're really focusing and specializing in this area so you can understand it. You're doing it on your side as well as for others as your business. Now, what is your plans for growth? And if you wouldn't mind me asking, where's your focus area? Is it still Texas? Like, how do you feel about that?
Yeah, it's a good question. So one of the lessons that I learned looking back at building a big multifamily portfolio is that you can't eat equity. So when the interest rates went from sub 1% to 7.5% in Canada on variable interest rates, it was like, oh, I wish I had a cash flowing business right now. So what we're doing is we're obviously solely focusing on the self-storage asset class, but we're creating a cash flow business, which is the Barefoot company. That's the company that sources the land off market, entitles it, and sells the paper, fully entitled and approved sites to other developers. So that generates a lot of cash flow. And then we can pick and choose the sites that we want to develop and put them into our portfolio. So we're essentially doing both. But one of the things that, again, back to the lesson is we're not going to just focus on development. We're going to have this dual purpose company. And so, and one of the other things that we're starting to get into now, because we have all the data, is making offers on the value add stuff. It wasn't our focus before, but we have the capital stack lined up, so that will be something that we add to it.
That's awesome. And how do you feel about over the next 4 years? Because I've seen a lot of reports out of a few large companies, aggregators, that they show a decrease in the development pipeline, especially the new starts coming online over the next 4 years. Do you see that continuing? What are your thoughts there?
Yeah, I mean, it's hard to have a crystal ball, but I would think that there is going to be a backlog because of what's gone on the last 2 years. And so if you can bring supply into the market in the next couple of years, I think you're going to have a good opportunity without having people coming in right beside you. So I think it creates an opportunity there. It's all going to be really dependent on, the debt. I mean, if the debt loosens up, I think there's a lot of money sitting on the sidelines ready to go. But I mean, at the end of the day, that's still speculation. So I think we still need to lean into, making sure that we're in undersupplied markets that have super strong rental rates. If somebody does come in, at least you can rely on the rates. They're going to go down, but it's better than having a mediocre rate site that's going to turn into poor just because of somebody coming in beside you. But
yeah, I couldn't agree more. If you will go back 3 years ago, a huge amount of these developments were developers that were flipping. They were just looking at a spread of cost of capital to cap rate and saying, geez, I can yield a ton because I can sell this at CO. And so it was frankly just speculation. And you brought this up at the first. You're looking at the top 100 operators, right? Like you're looking at people that are building to own.
Yeah.
Own, operate. These are people that understand it. They're okay holding it. That's not a problem for them. That is a wild, wild difference in attitude of development than we've seen. But 3 years ago, that attitude is still playing out today, meaning that when people started it, development it's not a light switch, right? So we're still seeing things come on board that were meant for that purpose.
Right.
Even though it was 3 years ago, where I think that you're right, the next coming 3-4 years, that's going to be gone. And it'll take a while for that to pick back up, which will generate a lot of opportunity for people that are in good locations, that are owner operators, because you then have the swing the other way.
Yeah.
You have a lack of inventory hit in the market. And I agree. I think that's an amazing opportunity for people that are willing to do it right? Because it's not that there's not risks, things like that. There is, obviously, and especially the big ones. What you mentioned, I say this all the time, but I'm like, in self-storage, you could be the smartest operator in the world, but if you're in an oversupplied market, you'll get killed. You can be an idiot in an undersupplied high demand market and you'll be wildly successful.
You'll look like a genius.
So I'm like, I'd rather just not have to be smart, and I'd rather do it that way. And if I'm smart, hopefully I can yield more, right?
Yeah.
But I think you're seeing a lot more of that. That's where people are going today. And that's because capital requirements, like you mentioned, get investors, banks, everything else. If you can't tell this story where basically you got your margin of stupidity, as I like to call it, like I can be an idiot up to this point and still be successful. They're not wanting this. And how are you doing your underwriting? Because right now we are doing like a zero basis, 3-4 years. We do not include rent increases.
Yeah, we're using current with no increase as well, just to be safe.
Yep. Before you had developers coming out and they're like, oh, but rates go up
Yeah.
12% every year. So by the time this hits the ground, they're going to be 50% higher. I think that's gone too.
Yeah, I don't see too many people doing that. Well, I have seen some syndication docs showing big projections like that, as well as cap rates down in the 4.5. So I'm like, you're out to lunch.
Yeah.
But yeah, we're using annual average rates just to kind of weed out some of the fluctuation from the peak to the bottom, but then we're just keeping it flat.
How many markets do you honestly, man, think are good markets right now for ground up development? Like that can meet a lot of these requirements?
Well, I honestly don't think that there's you can't just pick MSAs. The markets are 3 miles wide. So there's a lot of them still, but it's like trying to find it is the hard part. They're needles in a haystack. And so one of the things that we're really looking at to give us indicators to where they are is like you said before, AJ, is growth. But yeah, dude, like we're finding undersupplied markets in Texas, just in like near Dallas. But again, it's a needle in a haystack. If you move that radius over like a mile this way, you're in the 17. And so I don't think I can confidently, you can't. I don't think you can say any MSA, any city, any county. It's so saturated that you're literally looking for a 3 mile market.
So we're doing our grand opening and surprise a development that we have going on. And, a lot of people are like, oh, it's a great market. Our facility that we put into that market, our one facility doubled the square footage.
Yeah.
You're talking 220,000 net rentable square feet. Like all it took was us to come into that market, wildly changed the market, like wildly. And so I think a lot of people have to remember that it can change fast. How do you go about making sure that you don't got some bozo like me that walks in and you got this great plan, everything, and I'm like, oh yeah, there's 6 square feet per capita. Now there's 14.
So we try to get it on Radius and Store Track as soon as possible. And then if people do come in, and because it has happened recently, actually, like it's almost like it happens 20% of the time. Somebody comes in, or they may have already been there and then they put their stuff on. So a lot of it is then you got to go and call them and kind of give them the, hey, like, what's up? How far along through the process are you? Figure out what their planning process is. What's the likelihood of them getting approved versus us? When would they get approved if they did compared to our timeline? Obviously, whoever's in the ground first is going to have a bit of an advantage, but doesn't mean that the risk is gone. And then how strong of an operator are they? Like some of the facilities that you'll see come on the market are, like you have to actually vet them. Like, is it climate controlled compared to drive up? Is it, sometimes they'll have, like I've seen recently in another site, it was like a 2-story office building and the bottom storage. I'm like, well, it's not really like their intended use is not focused purely on operating storage. And it was going to be a 4-phase development, right? Like, so you just have to weed through it. But I don't think you can't mitigate the risk, but you need to try to show your name everywhere to hopefully you get smart developers around knowing, hey, you know what? This wouldn't make sense for us to cannibalize each other. Now, on the other hand, like I've also sold sites to other developers that have came in close and sold them our parcel instead of them doing theirs.
So they're just going, hey, we would just rather reduce competition.
Well, exactly. Like you position it in like, I'm not really into self-cannibalizing myself. Like one of us has to go. It doesn't, and generally our site's, better ideally. And I mean, this happened in a Florida site up in Jacksonville, but there's another North Carolina site that is super undersupplied. Another one came in about 2 miles away. Good location, but the market is it's really low from a saturation standpoint. So, but yeah, like, I mean, to your point, it happens, and you can't prevent it. You just have to do everything you can to try to mitigate the risk, show your presence, make the phone calls, do the work to try to get them to stop. And at the end of the day, you just got to move fast. That's the name of the game. It's like, if you are going to move through approvals, you have a certain point where there's going to be a point of no return, right? We try to do as many entitlements and do a lot of the risk under contract, and then just make sure that you're not screwing around and dragging out this pre-development and design process so it takes 2 years so they can get ahead of you.
One of the interesting things that I've seen, and I think some of this will actually go away, but we have some operators that came in a few years ago and it was like, we don't care about competition. We don't care about anything else like that. It's good. It'll be good here in this market in 10 years. So basically the market's growing. So whatever, rates are going up, everything else like that. They're like really far view out. It'll be good intent. Do you see that right now? Or are people looking like this needs to work day one?
Yeah, no, we're not seeing that. Now, I mean, there is some high net worth operators that aren't big brands that are doing that more so on the drive up specifically, where they have a thesis that they're rolling with, and it doesn't really necessarily matter if it's oversupplied with regards to total supply, but as long as the drive up is low within a certain threshold, we're seeing that type of decision making with that particular company, but not in a whole. Like everybody is super tight and strict. Like in general,
Yeah.
There's not a whole bunch of speculation going on, even in sites, dude. Like where we've got in Dallas, Georgia, just north of Atlanta, like there's literally no self storage in a 5 mile. You would think that would sell instantly, right? And it has over $20 rental rates, but it's not so. It still took a good local buyer, local developer that understood the market, understood where the people are coming and building and to want to go in there.
That makes sense. When you're working with somebody that wants to do this in a market, because a lot of people will have a market. It's not even so much that they're looking to do this. I have a market. I want to be in this market. I can't get in because there's nothing to buy. So nobody's selling, so I can't get in. So what do they need to know? Like before they go to buy land to build a storage, what are you walking them through saying, this is what's got to happen?
Yeah, I mean the biggest thing, like we have some buyers that say that they give us like an area that they'll outline on a map and say I really want to be in here. What we do is we go and get all the land and call every single one of those people. And sometimes there just is none for sale that is good for storage. Meaning zoning is maybe just too much of a hurdle or the price point. The other thing that really stops, even if you do get a parcel in some of these really niche markets, then the land value is also another big thing that kills the deal. So yeah, sometimes like from a development standpoint, I mean, sometimes it's tough when the buy box is geographically centric. That is the primary focus. But just because to my, like what I said before, AJ, was just like to find a good profitable, like high rates, low supply. It's like, dude, that's like, it's a needle in a haystack. So then you add the intricacies of, okay, finding available parcels of the right size that have zoning that either could get use approval or rezone, right? Within a jurisdiction that would actually approve that. That's another just a big hurdle. And then trying to get that parcel, if all those things align and the seller wants to sell for the right price. It's like the stars do not align very often if that's the strategy.
Yep.
So it's going to be pretty difficult to build a portfolio in any predictable fashion with that strategy, in my 2 cents.
I agree. Talk to me real quick here about the actual building cost. What are you seeing?
So we're focused more so on the entitlement side. That's what our most current numbers are. But some of my friends who are self-GCing, that are developing and self-GCing, they're able to get their construction costs under $80. Now the other developers that aren't doing that, the bigger guys that are GCing everything out, they're definitely in the 90, 95, and even $105 is what I've been told.
Yeah, for drive up.
Yeah, it seems like a lot of the guys, a lot of the groups that are starting to create development companies within their company so they can look after the construction, get the costs that 15 points cheaper. And that's moving the needle on whether these deals make sense or not. So we are seeing that a fair bit.
What's your prediction on these market rates when new supply hits? Are you seeing that when some of this new supply hits, is there a pretty big dip, or are they just matching market and holding?
It's hard to tell, to be honest. I mean, it's hard to tell with with what's actually happening in their ramp up of pricing, right? Like if when people drop 50% on their web rate, I don't know how fast, they're getting back up to market rates. Like, what's your take on that? I wish we knew.
Well, interesting enough, I was looking today at some of our markets. When it's just us, we'll hit it kind of at the top. We're not tanking rates. And I've seen a couple others. That is wildly different than it was 2 years ago. 2 years ago, new supply came out, fraction of the rate. Now they're still under, and I know that the big boys, they are still discounting at mass. Like you'll have huge discounts, jacking up rates immediately. That game's still going on, but it's not like it was over the last 2 years. I think we've gotten a breather because that was really bad. Like, we were seeing people coming out 60% under market rates. So we're not seeing it to that level, but we are seeing it. And two, also, I think it really depends on the time of year. If you got supply coming out in fall, the rates, they're putting out are way lower as opposed to spring. They're just under. But I think we have seen some strength on that which is good because it was 2 years ago, right? It was bad.
It was a mess. Yeah. Yeah. And I think we're getting more comfortable in being able to predict what's real, even just what their walk-in rates are at showing. And just also not just looking at one facility to try to determine rates. Like if you can get some U-Hauls in there, if it's all REITs, like they tend to hold their rates a lot more competitively. You can even if it is fully REIT saturated, we tend to find they're not all dropping their pants.
Yeah.
You just have to keep looking at site. You almost get a sense of what's going on in the market, and it's hard to prove it though.
Exactly. No, it is. It's because that data does lag, right? So
yeah,
you're seeing things that are happening. You have this feel, and when you're in it, like you're getting real-time data from assets, things like that, but you're not getting published data. So you don't really know.
No.
You're kind of going, okay, we think that this is happening, but I'm not in some other areas. So you kind of have to, everything else is produced at a year behind. And right now things are changing so fast. They're moving so fast, right? That can be very much like that was true 6 months ago, but it's not true today.
Yeah.
And I think that too is different. What we've seen is rebound. So we're seeing markets that are stabilizing and rebounding this year as opposed to nothing to like what they were, but definitely we're not seeing drops continue like we had the last 2 years. So are you seeing the same?
Yeah. I mean, right now at this exact moment, I feel like we're a lot of the markets are at their bottom again, just seasonally. But I do feel that we're getting stability from the REITs more so than we were the last couple of years.
And I think they got a lot of heat. That was one of the problems. I think they got a lot of heat. Like people were upset at the excessive rate dropping to take market share. And I think we have gotten help, and I think we've seen kind of a pause from that, which is really good because that was really bad. That was a lot of people were getting upset. And so I think so too. I think the REITs have been coming back on board with going, hey, no, we can't be doing this. We're destroying our own market.
Right.
So like that doesn't work.
That's what we're seeing. One of the things that we're seeing from an opportunity standpoint, like there's a lot of markets, again, I'm talking like a 3 mile market, so this could be anywhere, but where there is a lot of class B or C in the market that have like mediocre rates, not rates that you would develop in, but trying to expose those pockets where a class A could achieve or should achieve, over $20 rental rates. And then so again, it's not a perfect science. And so, but that's what we're seeing. It's like, dude, like this has all the right signs, undersupplied, reasonably strong rates for these crappy facilities, right? With low amenities, no fences, that kind of stuff. In those, there seems to be like, those could be the needle in haystacks, for the future. It's just, it's one of those things, again, you're trying to expose an opportunity where you don't have the data to support necessarily. You do have to start going, okay, I'm going to look at the 5 mile. Is there any class A in the 5 mile to support strong rates? And even go outside of that to start to collect data to start justifying it. But that's how hard it is to create, this amount of opportunity.
100%. Well, dude, I think it's an exciting time to be in it. And frankly, you came in it, at the end of that big boom and coming. I think you did it at the right time though. I really do. As you mentioned, we have mentioned, it's shocking to me how much of our competitors are gone.
They're gone.
Just gone. They're like, we're sitting here going, what in the world happened, right? Like we're the only ones out here. So I think it's really good timing for you. Really the people that are still in it are the hardcore ones. And those are the best to build those connections with and everything. Anyways, they're not going to be in and out. They're not going to be flimsy. So I'm excited. Where can people go to find out more about you, get a hold of you, dude?
Yeah, so our website is barefootlandco.com, and they could also go on Instagram, brady.mcdonald84.
Right on. Everybody, go check them out, learn more. And dude, thank you. Thank you for coming on and telling us what you're seeing and what you're doing. I'm excited, and it'll be great to hear in the next couple of years how all this goes for you.
All right. Thanks a lot, AJ, for having me. I appreciate it, man.